Imagine opening your car insurance renewal notice and seeing the price jump by $300, $500, or even $700. You check your record. No accidents, no speeding tickets, no claims. You did not change cars, add a teenage driver, or move to another city. From your perspective, absolutely nothing changed. So why are you suddenly being charged more? The answer reveals something most drivers misunderstand about insurance. Your premium is not based only on what you did last year. It is also based on what the insurance company expects thousands of other drivers to cost them next year. And that is why even a perfect driving record may not protect you from the next increase. Imagine an insurance company covering 100,000 drivers in your state. Every driver pays premiums into a large pool of money. That pool is used to repair damaged vehicles, replace stolen cars, cover medical bills, pay legal expenses, and settle liability claims. The company does not wait for accidents to happen before deciding what everyone should pay. It estimates how expensive future claims are likely to become and sets prices around that prediction. This means your insurance rate is partly personal, but it is also collective. Your driving history matters, but so do the accidents, thefts, and claims happening around you. If thousands of drivers in your area begin filing more expensive claims, the cost of insuring the entire group can rise. You may be one of the safest drivers in the state, but you are still part of the same insurance market. This is the first reason safe drivers receive higher renewal prices. You are not paying only for your own past. You are also paying for the insurer's estimate of future risk in your location. Consider two drivers with the same age, vehicle, coverage, and clean record. One lives in a quiet area with low theft rates, light traffic, and relatively inexpensive repairs. The other lives in a crowded area with frequent accidents, vehicle theft, vandalism, and costly body shops. Even though the drivers look identical on paper, their insurance prices may be very different. Your clean record can make you cheaper than another driver in the same area, but it cannot eliminate the risks associated with the area itself. The second reason premiums increase is that even a minor accident can now create a major repair bill. A bumper used to be mostly plastic, paint, and labor. Today, that same bumper may contain cameras, parking sensors, radar equipment, wiring, and components connected to driver assistance systems. After the physical repair, the vehicle may also require diagnostics or recalibration. The technology can help prevent accidents, but when damage occurs, it can make the repair far more expensive. Your insurer is not only thinking about the value of your own car, it is also thinking about what your car could hit. You might drive an inexpensive sedan, but if you cause an accident involving a new electric vehicle, a luxury SUV, or several cars, the liability claim could become extremely expensive, and damaged vehicles are not always the largest cost. Serious accidents may involve medical treatment, lost income, rehabilitation, lawsuits, and long-term injury claims. The cars may be repaired within weeks, while the medical and legal costs continue for months or years. This is where the system feels especially unfair. Your clean record describes what happened in the past. Your renewal price attempts to predict what coverage may cost in the future. If parts, labor, rental vehicles, medical care, or legal claims are expected to become more expensive, your insurer may raise rates before you personally cause any accident. There can also be a delay between rising claim costs and the bill you receive. Repair prices may increase first. Insurers collect the data, update their projections, and request new rates where approval is required. The increase may then appear at your next renewal, months after the underlying costs began rising. That is why your bill can suddenly jump, even though nothing happened to you recently. The renewal notice is new, but the calculation behind it may reflect trends that have been developing for years. However, not every increase is caused by the wider market. Personal changes still matter, and some are easy to miss. You may have lost a discount. Your estimated mileage may have changed. A driver or optional coverage may have been added. Your vehicle may have been reclassified, or your address may now be rated differently. In some cases, incorrect information in your driving or claim history may also affect the price. That is why the first step after an unexpected increase is to compare your new policy documents with the previous version. Check the vehicles, drivers, address, annual mileage, coverage limits, deductibles, and discounts. Do not simply accept a vague explanation about market conditions. Ask the insurer what specifically changed and whether any discounts expired. The next step may produce the largest saving. Compare quotes from other companies. Different insurers can evaluate the same driver very differently. One company may have experienced expensive claims in your area, while another may be trying to attract new customers there. One may price your vehicle aggressively, while another views it more favorably. Staying loyal to the same insurer does not guarantee that it will continue offering the best price. But make sure you compare equivalent coverage. A quote that appears $500 cheaper may contain lower liability limits, a much higher deductible, or fewer protections. Compare the same drivers, vehicles, limits, deductibles, and optional coverages. Otherwise, you may believe you found cheaper insurance when you actually purchased less insurance. You can also ask how changing your deductible affects the premium, but never choose a deductible you could not comfortably pay tomorrow. Saving a small amount every month does not help if one accident leaves you unable to afford the repair. Review bundling, low mileage, defensive driving, and vehicle safety discounts as well. Telematics programs may offer savings, but you should understand what driving data they collect and how that information may be used before enrolling. So why did your car insurance go up when you did nothing wrong? Because car insurance is not a reward system based only on your personal behavior. It is a risk system that estimates the future cost of accidents, repairs, theft, injuries, and lawsuits across a much larger group of drivers. Your clean record still matters, but it cannot completely protect you from rising costs elsewhere in the market. The most important lesson is not to treat your renewal notice as a price you must accept without investigation. Find out what changed. Verify the information. Compare equivalent quotes. Review your discounts and deductibles, and do not remove essential protection simply to make the monthly payment look smaller. You may not control how expensive cars, repairs, and accidents become, but you can control whether you blindly accept the first price you are offered. Being a safe driver may not prevent every increase. Being an informed customer can still prevent you from paying more than necessary.